What is up, you guys? Today we are going to go over how to never blow your trading account up ever again. Now, luckily, hopefully you're somebody who has never blown up their trading account before, but if you're somebody like me, you probably have. You all know my story of how I lost over $25,000 in a week, $10,000 in a day. There's plenty of videos on this YouTube channel about that, and I didn't use any of these rules that I have set in place right here. So what I want to do is kind of go over how to not blow up your account, and more importantly, how to build a trading plan. And we're going to go over in this video specifically how you can build a trading plan. And I'm going to show you a clip from one of my my courses that I created over building a trading plan. Now, having a trading plan is the most important aspect of trading in general. No matter what it is that you're going to be doing, you have to have a plan, you have to have a manual, you have to have instructions, and that's going to be deciding on your failure or your success. I mean, try building an IKEA dresser without instructions. You probably couldn't do it. And if you could do it, probably couldn't do it as well as if you actually had the instructions in front of you. So having a plan is the most important thing, especially when you have a stressful or problematic situation. When you're stifled, we don't think correctly. You know, if you look at a professional boxer or a professional fighter, right? A lot of people will say, well, all he has to do is, stay on the outside, hit him with the jab. All he has to do is cover up, hit him with the leg kicks, like the most rudimental things that we all know to do. But once you're put in a stressful or a problematic situation, or with fighting, once you get hit in the face, all of that goes out the window. You lose your basic plan that when you first walked into the octagon, or with trading, when you first sat down in the morning, you lose what you wanted to accomplish for the day, and you don't think the same way as when you had a level head. And so the first thing, keeping a level head. You cannot let your emotions control you, or it's just not going to end up well, whether it's trading, investing, or any aspect of life. We are animals. We do not always have a level head, but the most important thing is to try to stay grounded while you're trading and while you're investing. Also, guys, hit the like button and subscribe down below. We're at almost 1,600 subscribers, which is amazing, and it really, really helps the channel. So thank you guys for all of that. We all have had a bad trade or a bad investment. I've had more than enough of both of those in my career, and we just, we lose a piece of ourselves every time we have a bad trade. That's primarily because we lose our level-headedness. And we look at every piece of evidence that is for our position rather than looking at it from an outside level-headed point of view and saying, hey, maybe this isn't looking good. Let's hop here real quick on the charts and let's look at SPY, right? If you were getting puts today, you would see that, at many times we were overpriced. The stock market had to come back. We're up almost 3.5%. But instead of, looking at, oh, this is actually uptrending, there's really no sign of coming back, you would look at every red tick and be like, oh, it's coming, it's going to come, it's going to fall. Only look at really what's supporting your actual thoughts and what you want to happen. And that is not good. And so the point of actually keeping a level head is that, well, actually, let's do this. On the flip side, right? Because we've all had an investment that's gone bad and we start freaking out and we start getting physically sick. I've had videos, I've had really, really bad trades where I've physically gotten sick. I'd watch myself losing $100 a minute. And to me at the time, it was a lot of money. And I would start to freak out. And so it does happen. But on the flip side, there's been times where I've been so euphoric, I've been so happy, I'm up so much money that I don't really look at things for how they are. I don't have a level head. And so I might say to myself, let's look at something like Twilio, which actually have puts on. But let's say you were somebody who had, calls before this happened, before the earnings, and it just kept going up and up and up and up. Well, once it's up at 175, once it's up at 188, you should probably get out. Like, even though it could keep going up, you just don't have a level head. You're so happy. You're like, oh, I'm up $2,000, $3,000, $4,000, but I could be up $7,000, $8,000, $9,000. So we lose that level headedness that we need to have as investors. And that's not good. So of course, when we look back at it later, we're like, oh, Twilio, it was up 20%, 30%, 40%. I should have gotten out. And looking back at things in hindsight, it's pretty easy to sit there and be like, oh, I should have, could have, would have done that. But that's why keeping a level head is one of the most important things that you can do. And the way to keep a level head is by number 2, which is understanding position sizing. So 9 times out of 10, the reason that we cannot keep a level head while we're trading is that we're trading with way too much money. Now, I'm going to make a whole video on position sizing in the future because it's something that has to actually be talked about in detail, and it's different for everybody. I can't just tell you like trade with 10% of your portfolio or 20% or trade with $1,000 or $10,000. It's all relative to your risk tolerance, and you kind of have to figure out what that is. But quickly going over that, the easiest way to calculate, the easiest way to stay calculated is really just to keep your positions small. Because we have to think like a computer would think. We have to have zero emotions when it comes to this. Let's say that I were to, take a position for $10. If that goes up 100% or down 100%, do I care? No, it's $10. Losing or making $10 is nothing to somebody like me. It might be to you, and that's fine. But a position that small, I don't look at that at all with any emotion. I don't care. Now, if I were to put 50 grand, 100 grand into a position like that, then I would be like, okay, hang on. This is too much money. Every little tick, I would be afraid. So what you're going to want to do is, let's say you have a $1,000 account. You're going to want to start trading with $100 at a time. Then you document all of your trades, document everything you do. And you look back and you say, okay, $100, I kept my cool. I was level-headed. I'll go up to 200. 200, all right, you're level-headed. 300, you're level-headed. Everything's fine. 400, you're level-headed. You get up to 700, 800, $900, and you start realizing, like, I'm paying attention way too much. I'm freaking out at the smallest amount of movement. I'm a little, too ready to cut my losses. You're not allowing things, which is good, but you're not allowing things to play out. Maybe you're taking profits way too soon. That's something that I do, and that's how I know I'm trading with too much money. So just keep gradually going up and up and up, document everything, and then once you find that number that just becomes too much to trade with, back off about 10 or 20% of that, trade with that, and then see, like, is this good for me? Do I like this number? And if it's still too high, start bringing yourself down. Like I said, I'm going to keep this section a little short because I want to make a full video on it in the future. It's something that's really, really important. And now the third thing, and one of the most important things, and you're going to see it here, is going to be actually building a plan, a trading plan. Now, for those of you who are in my private academy, you will know I created a whole course on the strike zone and the science of hitting. I think it was by Ted Williams, but Warren Buffett is the one who really brought it to light for a lot of investors. Also, if you're not part of the Capitalist Academy, it's only $30 a month. You get access to over 55 hours of courses and private lectures. You also get access to our Discord, where I live stream every single morning from 9 to 10 in the morning. I go over what I'm trading. I answer questions. It's an amazing community to be a part of. So if you sign up before June 1st, it's $30 a month for life. Then it's going to go up to $50 a month starting in June, and then probably $100 a month in September. So I'll put the link below. We would love to have you. But if you're in my academy, you will see that this looks pretty familiar, because you guys have seen this in the How to Trade Like a Professional course that I made. And this goes over actually what I consider to be a strike zone. So there's a really good interview out there with Warren Buffett, and he talks about this book, The Science of Hitting. And in this book, I believe it was Ted Williams who wrote it, he puts this little graph here, right? And for those of you who don't understand anything about baseball like myself, everyone has a batting average. So what he did was he documented where his best spots were to hit the ball. So obviously you can see here in the red, if it came down the middle, he had his highest batting average. If it came, a little left and in the middle, second highest, third highest was right in the middle. And you can see his worst area was in the bottom left. So you would say, well, if you're and we're going to tie this into stocks, but if you're a baseball player, how about you just don't swing when it goes to the bottom left? That would make sense. If you're not good at hitting the ball when it goes to the bottom left, why would you swing? Well, in baseball, you can actually have 3 strikes and you're out. So if the pitcher were to just throw it in that area, you have to swing at it at some point. But the beautiful thing with investing and the beautiful thing with trading, we don't have 3 strikes. I can sit here and I can wait all day. I can wait all week. I can wait a month. I don't have to take a position. And that's the beauty of it. And that's why you guys need to be really disciplined with what positions you're taking. And this is why I say all the time, document every single thing that you do so that you can create your strike zone. Because what really changed my trading career was I documented hundreds of trades. And I looked back and I said, well, how did I fail? Right? One way that I failed a lot back in the day was trying to get puts on these breakouts way too early. So I stopped doing that, right? And when I stopped doing that, I saw my overall yield monthly go up. I realized that going in with $5,000, $6,000 to start an options play was not good because I started to get too emotional. So I started to cut that down. Having your strike zone and finding your strike zone is one of the most important things. I'm going to call it a strike zone, but it's really your trading plan. And so I'm going to go over my strike zone, what it would kind of look like, and then you guys can make your own strike zone. You guys, while I teach a lot about trading and investing, the point is for you guys to make your own style. But let's go over what my strike zone would look like if I was starting out, right? And the most important thing is to keep your strike zone or keep your trading plan next to you on your desk at all times, because like we talked about with the boxer and with the MMA fighter, you might know all this until you get rocked, until the market humbles you, until you're in a position that you're freaking out about. That's why it has to be in front of you to help you keep a level head. So the first one, don't trade against the trend. So, if we look at the S&P 500, before we had this big market sell-off, what was the trend? Up. You know how I lost a lot of money? Trying to go down, right? Every time I try to guess the fall, I would end up losing money. So always trade with the trend, right? It's so hokey and stupid, but the trend is your friend, and it's one of the most important things. The second one is that it must have a good risk to reward ratio. So I say 2.5 to 1% minimum. I like to have a 3 to 1%. You have to have proper risk versus reward. And if you guys are part of the academy, we have tons of videos on that, and I will be making some for YouTube in the future. And the third one now is to try and not time a reversal. Now, I have been doing this because I've been trading a long time. This is a trade I'm currently in right now where we are timing the reversal of Twilio. This is because I've been in the market a very, very long time. But when starting, I would advise against this. I really would. I don't think you should try to time the downfall of something that's going parabolic. That goes back to number one, where it's don't trade against the trend. Now, of course, you guys can do whatever you want, and maybe you're good at timing reversals. This is why keeping data and tracking everything is important. The fourth one is the stock must have a $1 billion market cap. So I will not trade anything with less than a $1 billion market cap. Why is that? Usually, if you have a $1 billion market cap or lower, you're not going to have a ton of options out there. Not a lot of people like writing them. And usually, a $1 billion market cap or lower company is usually going to be a lot more volatile. And I don't trade pennies. I don't trade pump and dumps. I don't trade any of that. Like number 5, with options, always go 2 weeks out than you think you need. This is very important for those of you who are my students. You understand the importance of something like this. Let's look at Twilio. I would think that this will probably take about a week to fade. If we take a look at how long it took to go up, if we see that the volume's coming out, we broke support, I think it'll probably take 3 or 4 days to fade 12%. Now, am I going to get an option that expires in 3 or 4 days? No. If you guys don't understand options, I will put my options video down below or put it somewhere up here that goes over options basics. And the point is that options decay. I'm not going to explain in this video how, because it would take a lot longer to do that, and I have videos on that already. But the reason you want to go 2 weeks out is because your decay is going to be a lot less, and you want to have more room for the position to actually be able to take effect and go the way that you want it to be. So always go at least 2 weeks out. 6 is to always set a stop loss. Know how much money you are willing to lose before you go into the position, because when you don't have a level head, it's hard to have a stop loss set because you're just like, oh, I'll move it down, I'll move it up. Don't do that. Have a stop loss set before you go into the position. Number 7, when positive on a trade, set a trailing stop loss. This will help you more than anything. So let's say you took shares of Twilio and you got in here at $120 and it ripped up to 150. That's a 23% return. Now, you don't have to go and just get out of the position entirely. What you could do is sell half, which would be great, or you can set a trailing stop. So say you're up 20%. You want to walk away no matter what with a 10% return. You could set your stop loss here at 136. Now, as we went up and then pushed up the next day, you raise your stop loss. As we go up, you raise your stop loss. As we go up, you raise your stop loss until eventually you stop out and you take your profits. This will stop you from getting greedy and wanting to just hold on to a position and make the most amount of money. So that's one of the most important things you can do. Number 8, when the risk outweighs the reward, sell and walk away. So now, if you were in this position on Twilio right now, the risk does not outweigh the reward. Even if we could bounce here, which I don't think we will, what are we going to go up? 7%, 8%, 9%, 10%, right? But we could easily fade to this 50, which is a 10% loss. So if you're in a trade like this and you're up money, walk away. The risk is not worth the reward anymore. So guys, that is really my strike zone. Now, I deviate from it a bit because I've been trading for so long, but the point of this is for you guys to create your own strike zone and for you guys to create your own trading plan. And remember, keep it on your trading desk at all times. You need to keep a level head, and even though you know the basics, even though you know all of this, common sense is not always common practice. I'll be the first one to tell you that. So make sure you put your trading plan next to your desk while you're trading. Comment down below if you need some help. I'm always here to help you guys. Comment down below what your trading plan looks like. I would love to hear what you guys are doing and what you're thinking about. Also, hit the like button, comment down below, subscribe. It really, really helps the channel, guys. And if you want to join the academy, I will put the link below. Thank you guys, and until next time, I'll see you.